Okay, Unam, you okay there?
Yes, I'm alright. So thank
You're
you.
back. Good. So it is quite a bit to get through every week, purely because this module is so big. There's like 28 chapters or so, so there's a lot of content that we need to get through. Um, Obviously, if you do have more time during the week, go through the material as well, go through the detail, read through all the chapters and everything like that, and then it should help make things make more sense. Obviously, we've been practicing quite a bit, and we did the assignment recently as well, so hopefully that will help as well in terms of your approach. Okay, obviously I want to try and get some exam papers at a later stage to go through them with you and see how to actually approach the questions there, so at least you have a better idea of how to answer those questions. Okay, so a little bit more to cover tonight. Study Unit 9, and then we've got a short theory chapter just looking at sources of finance. Okay, you ready?
Okay, so
Study Unit
yes,
9,
I'm ready.
alternative methodologies for solving TVN problems. Okay, obviously if it's an alternative, it's looking at a different way of calculating things. And this is where you had those big tables, where you had those table A, B, C, and so on, okay, where you're using those factors. Okay, because back in the day, before the use of financial calculators, mathematics was done using these interest factor tables, because the tables had already calculated the discounting or compounding, and then all you had to do was multiply your present value or future value by the amount, and then you would get the final answer. Okay, things have changed quite a bit because nowadays we use technology, so we're lucky and fortunate to have a financial calculator, so we get more accurate answers as well because there's no rounding and things like that.
Yes, sir.
Okay, so that's pretty much what they've mentioned here. Use the pre-calculated interest factors tables. That's one way of doing it if you're wanting to do it manually. And then you'd have to use table C, table D, and all the other tables that they give you for discounting or future value calculations, depending on what you've been asked to do. Okay, table A, present value of 1 Rand. Table B, present value of 1 Rand will for an annuity. Table C is the future value of 1 Rand, and D is the future value of 1 Rand but for an annuity. Okay, so again, as I said, these tables are looking at using factors, okay, pre-calculated factors that help you to determine what the actual answer is for a future value or present value amount. Okay, we're going to use the financial calculator, so more practice. Which time factor? Okay, we don't need that. The relationship, we've discussed this already, FV, PV, and payments. We know what the difference is. We know an annuity is a sequence of regular payments. How will you solve these problems? Okay, so there they've given you notation. When you see this is notation. You've actually seen this in DSC. I don't know if you can remember that far back.
No, I don't think you've put anything on the screen because I'm kind of following I can't see anything on the screen.
Oh, okay, yes, sorry. You should have mentioned that. Yeah, sorry,
Sorry,
share the screen. Now the share's up.
Sorry, I was just following on my textbook.
Okay, yeah, sorry about that, but yeah, we're currently here in terms of the relationship. So, we were looking at the PV, FV, N. We've discussed that. It's this that I was referring to, notation. Okay, you remember in DSC you had something like this, R, and then you had this, and then you had an A, and you had an N, and then you had a rate.
Yes, I remember that.
So you had an A. So A was present value, S was future value. Okay, you remember that notation?
Yes, sir.
Yeah, so that notation is basically just a representation of the equations. Okay, the mathematical equations for calculating either present value or future value, depending on what they're asked for. Okay, what you've been asked for. Right, but as I said, don't worry about tables. They're not very accurate. The best way to do it is to use the financial calculator. See, they're even talking about reliability, reasonability check. Okay, obviously, can you do all calculations using the tables? No, you can't. Okay, the table is limited in terms of the amount of periods and also the amount of rates that you can use. they do try to use the more common rates, okay, like from like 1% up to maybe about 20%. But obviously, if I had to put in, let's say, 40%, the table might not provide for the actual factor, and that's a downside regarding the table. If I use the calculator, you're not restricted by the interest rate, and you're not restricted by the periods. You could calculate, if you wanted to, you could calculate the future value after 100 years. Right, the present value factors in the table won't be able to do that. They'll have to keep building a bigger table in order to get the factor over 100 years. Okay, but that's just insane. Okay, drawing up a table for 100 years is how many months? 1,200 months. That's how big the table is going to get.
Yes, sir.
Okay, it's not a very productive or efficient way of calculating present value, future value, right? And that's why you need to focus on that. Either use the Sharp or use the HP, but use a financial calculator to do the calculations. That's what you're going to be doing.
Yes, sir.
When they talk about decimals, preparing your calculator, remember to clear everything. We've mentioned that already. Using 3 methods. Obviously, you've got different types of calculations you can do. We need to now practice. Okay, there's one. Okay, so I want to know what the future value is after 1 year and 3 years. Quickly grab the calculator, plug in the values, tell me what you get.
Okay, rest 5,000 present value and 14i for 1 year in. Future value for after 1 year, it's 5,700.
5,700, perfect. Okay, now do that for 3 years. What do you get?
14 is I and 7,407.72 cents.
7,472 cents. Perfect. There you go. Nice. Okay, and that's what you're going to be doing. All right, you can see the textbook's very good. Okay, they've shown you. See, that's how you do it on the calculator. Okay,
yes,
this is how you do it using the table. This is how you do it using a formula. Okay, that was for A. Okay, same thing with B. You got the right answer. That's what you got. This is using the formula. This is using the factors in the table. This is using your calculator. Does it matter which way you use? No, it doesn't. As long as you're getting the right answer. Okay.
Yes, sir.
Preferred method is definitely calculator. So use your HB10B2 plus. That's the steps. That's the answer. Keep it simple. Just use it as is. Okay, nice. Right, same story. Grab the calculator. I want you to work out this. Value of the investment after 4 years. So what is that? Future value, right?
Okay.
Okay, notice it's an annuity. Okay, so grab the calculator, substitute and solve. What do you get?
Okay, so 5,000 PMT. The end of each period, it's 14% is my I.
Good.
Over 4 years is my N. I'm solving for FV, which is 24,605 and 72 cents.
Yeah. Again, if you want to look at the other methods, the textbook gives you all of them. It gives you the factor, it gives you the formula in terms of mathematics, and it gives you the calculator. Alright, good. Here's another one. Using the same information, assume that 5,000 is invested at the beginning of the year. Okay, so 5,000 invested at the beginning of the year, and we're using the same information that was given here. Okay, so beginning of the year instead of end. What do you get?
First thing, I change my calculator to the beginning of the year. I put in 5,000 PMT.
Yeah.
15% is my I over a period of 4 years, which is my N. And then I key in. I'm trying to solve for my FV. It's 28,050 and 52 cents.
Good. Okay. Easy, hey?
Yes, sir.
Alright, here's another one. Present value of a single future cash flow. So if it's a single future cash flow, you're looking at one cash flow at the end, which is future value. Do you agree?
Yes, sir.
Okay, discount that back. determine the current amount that you should invest now. Get
Okay.
PV.
So firstly, my I over YR is 14%. You will receive 8,500, which is your FV, or 4 years, which is your N, and we're trying to solve for PV, which is our 5,032 and 68 cents.
Perfect. Okay, yep, 5,032 is right. Nice. 68 cents is even more accurate. Okay, you can see the calculation on the calculator gives you a more accurate cents figure than you would get if you used like the factor or the mathematical equation. Okay.
So,
Right, next one. Determine what the present value is of this annuity at the beginning of the first year.
okay. Well, you change our calculator to the beginning. An amount of 1,000 was our 1,000 is our PMT. Our 3 years is our N. 10 is our I. And we're solving for PV, which is 2,735.
2,700? No.
No?
2,400. Something went wrong.
Okay. Well, okay. So yeah, at the. Oh, sorry. I didn't change it to end.
Yeah, it's in mode.
At the end. Yes. Sorry. Let me just.
Beginning of the first year is times 0.
Yes.
Do it again. What do you get?
So for present value, it's 2,486 and 85 cents.
Good, nice. Okay, that's it. That covers that one. Here's another one. Present value of a perpetuity. Okay, so here you have no choice. With a perpetuity, you need to use an equation, right?
Yes. Which is right. If I PV equals PMT over I.
Good. Work it out. What do you get?
My payment, which is 24,000, divided by my I, which is 0.14, equals 171,428 and 57 cents.
Very good. Okay, nice. Here's another one. Do this one. Determine what the present value is of the annuity. Can you do that on your calculator? Let's see.
Okay. An amount of 6,000 is invested annually. 6,000. Okay. 6,000. At the beginning of each year, so I just change my function to beginning. 6,000 is my PMT. 10 is my I. 3 is my number of years, and I'm trying to determine the PV of the investment. It's 16,413 and 22 cents.
Nice, good. That's another one. Nice. Okay, let's carry on. Where's another one? Here's another one. PV of unequal amounts. Okay, so when you have unequal amounts, we use the cash flow button. Remember I showed you how to do that earlier?
Yes, sir.
Okay, practice. Let's see. Can you work this out? We want to know... what do we want to know? The present value, that's it. Present value of the future income. What is it? So in other words, net present value equals question mark. Okay, can you use your calculator to get the NPV?
Yes, sir. So first thing,
tell me what you're doing.
Oh, the first thing that I'm doing is I'm making my my T 0 0.
Good.
And then time 1 is after that you say cash flow, then you say CF, and then you say 1,000 CF for your T1, your 2,000 for your T2 CF, 2,500 for your T3, and 3,000 for your T4, Second function NPV, which is 8,500.
Did you put in a rate?
Oh shucks, I didn't actually know.
Yeah,
Wow.
6%. You forgot the rate at the end.
I
Do it
didn't. Oh yeah,
again.
it was. Sorry.
You forgot the rate. You put in everything. You just forgot the rate. 6%.
Yes.
Okay.
Okay.
Redo.
Zero.
6%.
1,000. 2,000. 2.5. 2.5. 3,000. And then my rate is 6% as I. So the function NPV 7,198 and 72 cents.
Perfect. Nice. Well done. Okay, here, repayment of the loan. We want to know what the annual installment is. The annual installment is PMT. Can you work this out? Grab the calculator, substitute and solve. What do you get?
PMT events financed. The loan is repayable. The loan is repayable over 15 years, including capital management. Okay, so I think it's financed a loan. So I'm trying to work out to do the annual installment requirement. Okay, so 100,000. I think 100,000 is my for a loan.
PV.
I think it's my PV, yes. I was about to say. Because we're trying to work out payments.
Trying to work out the payments, exactly. Good.
Yes.
Plug it in and solve.
15 years is my N. 18 is my I over R. So for PMT, which is 19,640 and 28 cents.
Got it. Good. Next. Deposit. Determine the annual investment. Okay, so again, annual investment meaning PMT. Work it out. What do you get?
Okay. You will need 40,000 as a deposit on a car. Okay, over the next 5 years. Okay. So 5 is my N, 12 is my I. Over the next 5 years, how much would you need? So 40,000 is I think it's my FE. And then I'm trying to solve for my PMT, which is 6,296 and 39 cents.
Yep, that's correct. Nice, well done. Easy, hey?
Yes, sir.
Okay, let's see if you still know how to work out the effective rate. Okay, what is the effective rate? It's the EFF.
Yes, sir.
Okay, grab the calculator. Let's see if you can work it out. Convert nominal to effective. What do you get?
Okay, the first thing that I have to do, I have to change my
P over Y.
Yeah, my P over where's that? P over Y. Deposited 8.5%, which is my I. So for EFF, which is 8.839090.
8.8390, yeah, 91. Perfect. Well done. Good. Second function EFF is correct. Nice. Okay, last one. 9.2. Alright, work backwards. Now you're working at the nominal. Okay, remember I showed you how to do it on the HP booklet?
Yes, sir.
Okay, let's see if you remember how to do it now. Okay, remember it's EFF first, then you do the payments over here, and then you work out the nom.
Alright.
Okay, go for it. What do you get?
Bank for investment branch. EFF. Okay, so the first thing is my 6.14. Second function EFF. Compounded quarterly. So 4.
P over Y.
Oh yes, P over Y. So I'm trying to change. And then second function NOM 6.00348566.
Well done. Good, eh? Easy, hey?
Yes. Sir.
Okay, so this chapter was very easy because we spent the whole hour and a half before this going through the basics. Okay, so that's why this chapter is more practice. I like this chapter because at the end of it, they give you some more practice exercises that you can do.
Yes.
Okay, so maybe after tonight, when you've not looked at this for a few days, maybe, then grab the calculator, go back to this chapter, look at the last few pages in the self-assessment, and see if you'd be able to answer all of them without looking at your books. Okay, if you do,
Yes.
then that's perfect, because then you know how to use your calculator. That's the key. The key is, are you comfortable using your calculator? If you are, you can do anything with it.
Yes, sir.
Okay,
Thank
so
you.
that I'm going to leave you to do. If you have any problems, let me know next week and we can discuss them if you can't answer all of them. Okay,
Yes, sir.
awesome. All right, we're doing well. Obviously, we're not going to use these tables. That's a very old school way of doing it. So ignore that. Use the calculator. Okay, there's the last bit. Okay, it's about 4, 5, 6 pages of theory. It's an introduction to the next section, which is looking at the sources of finance and how do we raise capital and all of that. Okay, so that's where I'm going to end tonight's session. Just a bit of theory just to wrap up. Okay, the first thing that I want to discuss with you is the markets. Okay, we've actually mentioned it before. There's 2 types of markets. Do you remember what they are?
I don't.
We touched on it when we looked at raising capital. Where do we raise capital?
We raise capital through equity or loan.
Good. Equity or debt? Loans, yes.
Okay.
Good. Debt or equity. Okay,
Yes.
so finance comes from debt or equity. Okay, that's where we're going to be raising capital. Obviously, in order to raise capital, we need a financial market.
Oh, yes.
Okay, we need a marketplace. We need a place where we can exchange our shares for cash, or we need an exchange where we can exchange our loans for cash, capital. Right, so there's 2 markets. You get a money market
Yes, sir.
and you get a capital market. Okay, money market, think of the word money. Money refers to something that's used day to day. Okay, people need money to transact. It's something that's used day to day. So when looking at the money market, you're looking at short-term financial products or instruments. That's what you're looking at. Okay, that could be an example like a 32-day account, a savings account. It's all short-term. Negotiable certificates of deposit, NCDs, treasury bills, short-term government bonds, anything short-term. Okay, bankers' acceptances. It's all short-term. Okay, that's what it is. It's literally short-term products. Capital market, think of the word capital. Okay, people invest capital over a longer term. So this is looking at the longer term financial instruments / products. That's what you're looking at here. Okay, so the one's long term, the one's short term. Obviously here you'd be looking at examples like bonds. Okay, those are normally longer term. You do get short term bonds, okay, but bonds generally would be viewed as being slightly more longer term than shorter term. Okay, so capital market, here you'd be looking at things like equity, maybe preference shares. Okay, and those would be long term instruments, okay, in that particular market. Okay, so that's all it is. It's literally a source of finance, meaning when a company needs to raise capital, where must they go? They need to go to the market. Okay, what is the financial market? It's a meeting place for buyers and sellers. Okay, so what do companies want? Companies want capital. Okay, what do investors want? They want a return on investment. Okay, and that takes place in the financial markets. Okay, so investors are wanting to invest, and they're going to be giving capital to those different companies. And those companies will be using that finance in order to operate, in order to expand their operations, to grow their business. And that's what you're looking at here when looking at topic 4. Okay, so topic 4 is being or has been introduced here. Okay, topic 4 is the focus, and they've given you sources and forms of finance. Okay, remember topic 4 is split into a few different chapters. Okay, where are we? There we. Okay, topic 4. Topic 4 has 2 study units, study unit 10 and study unit 11. Okay, next week we'll start with forms of finance. We'll discuss that. Tonight we're just introducing the sources of finance. Source means where we're getting something from. Do you agree?
Yes, sir.
Okay, the source is the where. That's basically what we're looking at. Okay, where is the capital coming from? That's the source. Right, so source can either be debt or equity. Obviously, there's pros and cons to both. Right, so when looking at the textbook, you'll see at the beginning they talk about this, shareholder wealth. Okay, you know that companies have to achieve what?
Long-term value.
Good, yeah, it's value. Achieve value, achieve wealth, achieve...
maximizing long-term.
What else can value be called? Equity maybe. Okay, but we're trying to maximize return on investment.
Yes.
Okay, so if someone is investing, they want value, wealth, equity in that business. And that's why they're looking at that. Sustainable shareholders' wealth. The only way we're going to achieve shareholder wealth is by investing. Okay, so taking resources and allocating those resources to a particular company or business. Right, and that business would hopefully grow and expand and be able to compensate the investor, either in the form of dividends or interest, depending on what type of investment the investor had taken out. Okay, so we're looking at debt and equity. Okay?
Yes.
Debt provides the investor with interest. Equity provides the shareholder with dividends. Okay, so those are the 2 forms of returns that you can get if I'm looking at the investment. Okay, so obviously as an investor you'd be looking at the sources of, let's say, assets. Okay, so where am I going to buy a particular asset? And if you're the company, okay, it's the opposite, where you're looking at where am I going to raise the capital. Do I want to get money from the shareholder, or do I want to get money from the investor? Okay, the lender. Okay, you can maybe call them a lender here instead of investor. The lender. Okay, because they lend money to the business. Okay, so the lender is going to be earning an interest payment in the form of a, it could be, well, later on when we look at bonds, we'll discuss it in more detail. But you're familiar with bonds. Okay, we did bonds in DSC 1630, so you know what a coupon payment is.
Yes, sir.
Yeah, a coupon payment would be a interest payment on behalf of the bond. Okay, the person issuing the bond. Alright, so let's carry on. That's just a note there about the legislation. Okay, so there's the first bit. We spoke about this, capital and money market. They've split into 2. Capital, long term. Money market, short term. Okay, they've given you some background, okay, relating to organizations. Okay, we know organizations need capital. That's important. We know resources are limited, right?
Yes, sir.
Okay, so what different forms of ownership do you get? Do you remember?
Yes, sir.
Give me them.
You get there's a sole proprietary.
And then when we get bigger, what happens?
Oh, we start a company?
No. After sole proprietor, partnership.
Oh, sorry. Yeah,
okay,
partnership.
Then what? Company.
In a company.
Yes. Okay, so that's the general progress in terms of growth. Okay, companies have limited resources, right? Which form of ownership has the most access to resources?
A company.
Why?
It has the most because they, I don't know, I want to say many heads are better than one, but they have more access because they are actually controlled by statutory requirements, and so because of that, financial institutions are able to provide them with uh, with more finances as well.
Yeah,
And
so
they
I'm
also,
glad you mentioned the
yes,
intermediaries, because the banks assist companies in raising capital. So that's a good point. Yeah, so definitely companies are going to be able to raise a lot more capital than any of the other forms of ownership, purely because they need to meet the rules and regulations of, let's say, the JSE or the London Stock Exchange or the New York Stock Exchange. It doesn't matter where those companies are listed. Okay, but those companies have an obligation, okay, to communicate the information to the public, because the public is actually going to be investing in those companies.
yes,
Right, so they talk about the company requiring capital. Okay, why do we need capital? Well, it's important for growth. Right, from your accounting, you know that information needs to be presented to the users. Okay, and what do the users use? They use the financial statements. Okay, and the statements are financial position, comprehensive income, changes in equity, and cash flows.
yes.
Okay, those are the four statements that a business would present the information on. Okay, and obviously you'd be using the information from those records in order to make decisions. But obviously, if I'm looking at the source of funds, they can be internal or they can be external. What's the difference?
Well, obviously internal. It's obviously within the company, so I imagine
Example?
that it's perhaps retained earnings.
Good. Profit, retained earnings, nice. And if it's
Yes.
external?
External, it comes from those financial institutions, so your banks,
Good.
maybe small business loan type of institutions as well.
Good. Okay,
Or
that's
says,
perfect. Okay, so internals within the company, externals outside the company. Right, so here they describe it as day-to-day running of the business. Okay, so if I'm buying and selling goods, is that internal or external sources of finance?
it's internal.
It's internal. Okay, so selling goods would be day-to-day. Okay, working capital, day-to-day. Right, then you've got obviously companies that are going to be raising capital outside of the company, which would be seen as external. Okay, so
Yes.
raising money internally versus raising money externally. Is the one better than the other?
Well, I imagine that raising it internally would be a little better, so that you're not paying any kind of interest. But I think the benefit of being able to raise it from external sources is the fact that you can gain a much larger sum of money
Yeah.
or resources.
Okay, that's good.
Those,
So definitely in terms of, like you said, the company will only have access to a certain amount of capital internally. Okay, maybe
yes,
the bigger the business, the more they'll have access to. But obviously, if you're raising money externally, you've got scope for raising more potentially.
yes, sir.
Yeah, that's a good point that you mentioned. Right, so here they've described the two different considerations. Are we going to use money from our internal operations, or are we going to raise money from outside the business? It also depends on strategy and also risk. Okay, risk is always something that we need to concern when dealing with making money decisions. Okay, obviously, risk is something that businesses need to mitigate or reduce as much as possible so that the company can maximize its returns. Okay, no one knows what's going to happen in the future, so we need to try to keep the risks as low as possible and then try to maximize the returns. Okay, that's also something else that you could consider here when either going with internal or versus external. Okay, then they talk about the markets here, which we spoke about. We spoke about capital being long-term, money market being short-term. They've described the capital market there, and they've described the money market on the next page. After this, I'll come back to that now. I just want to show you, there's it, money market. Okay, those are the two definitions. Okay, make sure you know what the definitions are, and then we just need to identify what falls under each of them. Okay, so let's come back to this. There's it. Okay, capital markets. Okay, if I'm looking at the capital market, there's two different, let's say, I want to use the word variety.
Yes, sir.
Okay, so you can either go equity or you can go bonds. Okay, it's two different items that'll be considered long-term or short-term. Okay, so when we look at the money market, even with money market, you could go long-term or short-term in terms of different assets, different type of assets. Capital also long-term and short-term. So products available from the bond / equity markets. Okay, and then that would be JSE. So JSE all share. Okay, that will be equity. Okay, or the bond exchange. Okay, where you'd buy bonds. Okay, you'd buy debt. Okay, a bond is a form of a loan. Okay, that's what you've got there. See, bond exchange in South Africa, and you've got the JSE, Johannesburg Stock Exchange. The one is selling stocks, and the one is selling bonds. Bonds are considered liabilities. Okay, but remember, liabilities that someone else is going to buy. So if you buy a liability, is that an asset?
Yes.
Yes, it is. Okay, because you're the one getting paid the interest. Does that make sense?
Yes, sir.
Okay, if it's stock, if I buy shares, then I get paid out the dividends. Okay, so stock would be seen as a form of an asset. Well, they're actually both assets, but asset in the sense that it gives a dividend. Okay, liability in the sense that it pays interest. Okay, but a liability can be seen as an asset depending on perspective. If I buy the bond, then I'm the one getting the interest. So the bond would actually be seen as an asset. Make sense?
Yes, sir.
Okay. Right, then they talk about background regarding the different markets. Okay, remember, if I'm looking at the capital market, you're looking at the primary, okay, or the secondary. Right, so obviously primary is when I first raise capital. Okay, so primary markets, when we first raise capital in the market. Secondary market is when we sell issued securities. Okay, so in other words, buying and selling assets already in the market. Okay, so here's the example. Primary market is if you had to go to the car factory and buy the car from the factory. Okay, secondary market would be buying a second-hand car from a car dealer. Okay, secondary is cars that have already been issued in the market. Primary is where I've bought directly from the factory, okay, directly from the supplier.
Yes, sir.
Okay, that's the difference. Okay, then they just talk about the types of transactions. Okay, you get two types of transactions: primary market transactions and secondary market transactions. Obviously, primary and secondary relate to this, the markets. Okay, so are we first listing on the exchange, or have we listed on the exchange and are we trading those instruments? Okay, meaning, are we buying and selling those instruments between other investors, or are we doing that between the company? Okay, so are we actually buying from the company, or are we buying from other investors? Same as what we spoke about with the cars. Am I buying from the manufacturer, okay, or am I buying from a different owner, okay, that's selling their vehicle? Okay, that's what you're looking at.
Would a primary market transaction, would it be also like a same example, but primary would be the buying a share from the initial offer when they first
IPO.
come up? Okay, and then the secondary.
That's good. Initial offer, you said, that's great.
Okay, and then your secondary is purchasing from someone who's trying to sell off their shares.
Correct. Public offering. Yeah, so the IPO would relate to the primary market, and then the secondary market would be someone who's bought shares already and wants to sell them. That's good.
Okay.
Okay, nice. Alright, so that's just a note there about the transactions, and then they spoke about IPO. There's the definition, IPO. And then there's just a note here about an example of the JSE. Then the money market, which we spoke about. And then I think that's it. Yeah, then they just gave you an example here where they just spoke about the different change, okay, in financing sources as the organization matures. Okay, so let me ask you this. If I'm a small company, am I going to be issuing shares in the JSE?
No, sir.
Definitely not. Okay, even private companies, I mean, you get very big private companies that aren't listed on the JSE.
Yes, sir.
Okay, not all companies are listed on the JSE. Some companies aren't, and they're private companies. So when focusing on this, changing your financing sources, it relates to what we also saw earlier. Remember we had a chapter called strategy.
Yes, sir.
Okay, it also depends on that. What is the business trying to achieve? Sometimes the business is going to have to issue shares, but by issuing shares, does that dilute our ownership?
Yes, I think so, sir.
It would. Okay, because think about it. Now you're getting other people buying your shares. So there could be an impact on ownership.
Yes, sir.
Because if enough people buy your shares, they can actually become the majority shareholder, and that can create a problem. Okay, so they've just given you an example here about a company expanding and maybe converting from private to public. Just a few things to consider. Okay, obviously you'll learn more about this in different modules. For example, the Companies Act, you won't really look at that. Okay, you'll probably look at that in more detail in subjects like auditing or law. You'd probably cover that in more detail. Or they've just introduced the concepts here in this particular example. Okay, the example is quite long. You can read it if you want to. It's just background information regarding primary market, secondary market, money market, capital market, all of the different ways of raising capital.
Yes, sir.
Okay.
And then so
that's
how does
the end of that chapter. Right, do you have any questions about the theory behind the markets? It's relatively straightforward. There's nothing too complicated here in this chapter. Any questions, or are you good?
No, I'm good. I was just gonna ask if I'm a sole proprietor, right? And then I work in my business for maybe 10 years, and then obviously we want to issue an IPO and everything like that, and then we carry on to such a point where people are actually starting to trade our shares and everything. How does a company, a big a public company like that, I suppose, prohibit a specific person or just a specific shareholder from becoming a majority shareholder? Do they just keep issuing more and more shares, or?
Okay.
Or
It's an interesting question. The thing is, once a private company has gone public, those shares are in the market. Right, you do get certain, they call them, it's almost like a restriction where you can place certain restrictions on the shares that you sell to try retain ownership. Okay, but if they're public shares and they're public shares, anyone can actually buy them. Right, so long as that investor is, let's say, capable of buying sufficient shares, they can ultimately take over the company. Okay, so what you're talking about there is something like a hostile takeover.
Yes.
Okay, where outside external parties keep buying more and more shares and try become a majority shareholder. It's not impossible to do that. Okay, if you can find enough people willing to sell their shares, and you might have to pay them a premium for it. Okay, if you do some searching, if you go onto the internet and you search for hostile takeovers, there was one that was spoken about not so long ago, about 2-3 years ago, where there was a bid to buy a pharmaceutical company, Adcock Ingram. Okay, let me see if I can find it. Do I have my... Yeah, I still have this open. Okay, let me just see if I can quickly search here. Adcock... It was Bidvest and Adcock Ingram. Adcock Ingram... Bidvest... There was another. There was I think it was CPR or CP something. There was another company, Chilean company. It's a Chilean company takeover, or it was a potential takeover. Okay, was it 2003? There, CFR Pharmaceuticals abandons Adcock Ingram takeover. Okay,
Yes.
that came from FT. Okay, I think that's Financial Times. There, Fin24. Bidvest can now block Adcock turnover. See, it was kind of like corporate, like you get wars, but this is like corporate wars. It's like boardroom wars, if that makes sense.
Yes,
Like
sir.
boardroom wars. Okay, for a lack of a better word. Okay, it's corporate takeovers, M&A, corporate takeovers. Okay, where companies are wanting to buy other companies, and they'll do so at whatever cost because they want to control that company.
Yes, sir.
Because certain companies are very, how can I say, attractive. Okay, obviously, back in the day here, you had two companies that wanted to buy Adcock Ingram. Why? Because think about it, everybody wants or everybody needs medicine. Okay, so
Yes.
this was something that was in the media, well, it's a bit older now, it's about 3 years now. Okay, so 2014, 2013. Okay, where you had this corporate action where you had a company from Chile, okay, trying to buy Adcock Ingram, and you also had a South African company which was Bidvest. Okay, Bidvest was also looking at purchasing Adcock Ingram. So you had two companies basically fighting over the control or the buying of another company. So it was quite interesting. You can see, obviously, it can get quite, let's say, ugly in a way, because here you can see in this article, Bidvest blocked Adcock takeover. Right, so they actually blocked the Chilean bid. Okay, so that company from Chile, okay, wanted to buy the company, and I don't know how they did it. We'll have to probably read more about it to find out the details, but it was blocked. So obviously businesses need to protect their own interests, and when looking at large businesses like these, you have massive companies with lawyers and teams of lawyers trying to outdo one another in order to take control of the business. Okay, but remember, takeovers aren't really good because takeovers are more negative than positive. Right?
Yes, sir.
You'd want a how can I say? You'd want a positive takeover. Well, not takeover, a merger. The word merger is a good or positive.
There's connotations around it.
Yeah, takeover. Okay, it's not referred to as a takeover. It's more like a merger or an acquisition. M&A, mergers and acquisitions. Okay, so there's two ways of looking at it. You can look at it as a takeover, which is more hostile. Okay, people wanting to control the business at whatever cost, or you'd be looking at things that are more peaceful. Okay, like a merger or an acquisition. Okay, and best example there would be AB InBev. Okay, buying out South African breweries. Okay, SAB. Okay, so in today's world, SAB doesn't exist. SAB is now part of AB InBev. Okay, it's a Brazilian company buying the whole of South African breweries. It's the biggest merger and acquisition ever currently. All right, the AB InBev buying out of SAB. Right, it was massive.
Yes, sir.
Okay, but yeah. Right, so yeah, good question. That's just something to consider. Yeah, so obviously if you're looking at this, sources of capital, obviously you can't stop someone from buying shares in your company if you're a public company.
Yes, sir.
Okay, you can try put certain restrictions in place in terms of the voting rights perhaps for the shares that people hold, but it's difficult if it's a public company.
All right. Thank you so much,
Okay,
sir.
you're welcome.